Good afternoon. This is Oliver Slow, Blue Line Futures, coming to you from the suburbs of Chicago with another episode of the 2 Minute Drill, which over the last few weeks have kind of morphed into the 2 Minute Square Drill, covering a few more markets than usual, getting a little bit more in depth. Before we get into the markets, do want to remind you, if you have not signed up for a free trial of our daily commodity commentary, head over to bluelinefutures.com. From there, you can select the markets that most interest you: grains, livestock, energies, metals, indices, interest rates, softs, etc. We've got a great team at Blue Line Futures who puts out a lot of great content, actionable content each and every morning. And if you've got questions over what you're reading, feel free to call our trade desk. We are here ready, willing, and able to help. And that is free to clients, brokerage clients. So without further ado, I guess we can kind of go ahead and get into the charts. The first one we got pulled up here, July corn futures. July corn had a heck of a last few weeks, and we got right up to some significant resistance levels. We had outlined this in the Grain Express over the last couple of days from about 472 to 474, talking about this being a huge pocket where if you've been bullish, you may consider reducing long exposure or looking to protect the downside. And with that same thought in mind, if you're bearish, it's an opportunity to look at protecting the downside. This was a big level back all the way back in January. This is where we broke down from. It became resistance. And coincidentally, that's where we tested and stalled out so far. Now we're just basically kind of backfilling this breakout point, which was previous resistance here all the way through March. So from a risk reward standpoint, if you had sold resistance, I think this is an opportunity to lighten up. And if you're bullish, this is an opportunity to dip the toes back in on the long side. A break and close below this week's low here near 454 and a quarter would probably start to neutralize that bias. Important to remember, we do have a WASD report at the end of the week, which could have big implications for price action going forward. My thought about this report, you probably get trade it for a few minutes, and then it's probably on to weather and spring planting throughout the Midwest, as it's been a little wet and soggy for a lot of folks out there. So I wouldn't be surprised to see that have a bigger impact on prices into next week's trade. Now, moving over to the soybean market, similar type setup here in soybeans. We had about a monster dollar rally and then just fizzled out up here at some previous resistance points. And now we're back testing the original breakout point here from just a couple of days ago, which comes in near 1220, 1224. We also talked about that in our Grain Express, which goes out each and every morning, about lightening up at these resistance levels and potentially protecting the downside if you have that bearish bias. Now, everybody's different. We don't have a magic 8-ball or a crystal ball to tell the future, but it's about finding these risk-reward pockets that you can take action around, and we certainly try our best to put those in front of you and give you some actionable ideas with that. So now that we're back here, potentially we can attempt to stabilize near this breakout point. Soybeans, I'm a little bit more cautious of near term. I think there are probably maybe a few more fundamental headlines down the pipe that keep me a little bit cautious, but it'll be an interesting market. If you're just trading the charts, and you don't have a position on right now, potentially we see a little bit lower price action, and it's an opportunity to buy, and then a break and close below this breakout point near 1215. That would be your sign to kind of move out of the way, as you could start to see a further retracement from the recent rally that we've seen over the last couple of sessions. Now, last but not least, the cattle market. We have just been struggling to get out above this 50% retracement, which is basically just a fancy way of saying the middle of the range from these highs back in March to the recent lows back in April, 178.42. If we're able to get out above there, I think you could probably start to encourage a little bit more of a rally to the upside and go retest 180, 182, where we started to break down here from the end of March. With that said, I don't know that we're going to be able to do it all, in a day's time. I think it's going to take work to get up there. We've seen open interest on the decline. We've been talking about headline risk looming, keeping funds maybe on the sidelines for the time being. So that's a good thing and a bad thing. The good part about that being on the sidelines is you remove the risk of excessive long liquidation. Funds are net long about 30,000 futures and options contracts. So if there are bearish headlines, that's not a whole lot to sell, as opposed to what we saw last fall when funds were long 100,000 contracts. Well, that's a big difference. You got a lot of people trying to squeeze out of a very narrow exit door, with funds long about 30,000 contracts. That exit door, not as narrow. And conversely, on the upside, if funds are staying on the sideline, you're probably not going to see that big move higher. So, we have had a roller coaster, as you can see, in the live cattle market. My thought, we consolidate, trade in the sideways range, which I think is good. I think that'll present a lot of great shorter-term tradable opportunities for traders on both sides of the market. So that's what we're looking at. That's what you should be looking at too. If you've got any questions, feel free to call our trade desk. Remember, trading futures and options involves substantial risk of loss and is not suitable for all investors.